The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Juliana Telebam, and these are your headlines today. US tech stocks wipe out $1 trillion in a single session as Trump's trade policies and growing recession fears spark a massive repricing in risk assets. Tesla's sell-off intensifies. Shares plummet 15% for its worst day since September 2020, piling pressure on CEO Elon Musk.
U.S. Secretary of State Marco Rubio says Kyiv will have to accept Russian control of some of its territory ahead of crunch talks in Saudi Arabia today. Investors buckle up for slowing sales at Volkswagen, with all eyes on the automaker's guidance when earnings hit the tape in half an hour. We'll hear from CFO Arno Antlitz at 8:30 GMT.
We have a very strong reaction on markets. Is it a tariff tantrum? That is one of the comments that some of the analysts are looking at. And don't forget, this is a market that has been bouncing very, very strongly on big tech themes, hoping that deregulation, a business-friendly environment under Trump administration would be very, very positive for stocks. So we don't have that reality today. We're talking about recession fears. We were tackling the idea of a recession very early on yesterday, and the view was, look, there was a lot of front-loading around the imports, trying to get ahead of the tariffs, which detracted from GDP, and as a result, we're now talking about a contraction in the first quarter on some metrics, but that's by no means a recession at this stage. Probability has gone up by some of the economists that, in fact, if the tariffs stay around for longer and some of the uncertainty, we could be talking about a contraction. But to me, yesterday, we saw a repricing of the probability of a recession. Doesn't mean we're having one, just a repricing of the probability. But don't forget those very overweight positions, as a result, having to reposition around the prospect that conditions may not be as rosy as they anticipated. But are we talking about a sell-off in anticipation of a recession or just a repositioning? I think it's a repositioning that we're witnessing.
When it comes to the selling, it seems like a lot of the unwind we've seen is hedge funds unwinding aggressively their positions. And I think it's a good point you make around what economists have been doing with their forecast, because we're not looking at base case scenarios of a recession here. We're looking at increase in the probability of a recession, but still it is not the base case for the majority of economists. Nevertheless, markets have tanked. We saw a major sell-off on Wall Street yesterday. You can see on your screens there the Dow Jones losing 2%, the S&P losing 2.7%, but it was the tech sector that bore the brunt of that sell-off, with the Nasdaq pulling back 4%, the most since 2022 in a single day, wiping out more than $1 trillion in the index's value. Tesla was a big mover to the downside. It lost 15% by the end of close, a major sell-off there, and I think twofold. Investors reacting to those lackluster sales in Europe, China, as well as in the U.S. in January and February. And then, of course, the political backlash that Musk is facing, given his political views and his role in Doge. Massive uptick in volatility. Here's a look at the VIX and where we stand. We are looking at the VIX spiking toward 30. We'll hopefully get you a check on that. But for now, let's look at bond markets, because we also saw a lot of action there, Karen.
Indeed, it was a classic rush to safety. So take a look at what we're seeing on the 10-year. And don't forget, a day earlier, we had also marked lower. So the 10-year now traveling, as you can see, 4.18%. So we have moved south on this trade. Very defensive aspect of this market. The short end, as we talk about the Fed, the market now slightly increased prospect of more rate cuts this year. So the 2-year has also slightly reset. 3.87% is what we're seeing. To the Asian markets that are dealing with this Wall Street sell-off. And don't forget, they've been very much traveling around the AI theme when we talk about the Hong Kong, Chinese markets, thanks to DeepSeek and Alibaba, local stimulus as well. But these markets, as you can see, caught up in some of that selling pressure. More modest on that Chinese decline on the Shanghai Composite. And you can see other major boards are selling off a little bit more than what you're seeing there. Almost 1% down for Hong Kong stocks, and 9/10 out of Japan. And the Kospi trades down 1.25%. So some caution certainly coming back into those Asian markets. It's all about futures. I think we're all closely watching whether we see some sort of a break to this selling pattern that has been ramping up. The point was made by some on social that, they bought the dip and now the market is still selling off. So the dip wasn't necessarily the dip. So you can see the market looking to see some sort of base, at least on the Dow this morning. Let's get to Shana Cecil, who is the CEO of Banrian Capital Management. Thank you so much for joining us today. Just help us out, because the market has been looking at the tariff fears, concerned that these tariffs are lingering more than they would hope for, that it's not perhaps just negotiation at this stage, but uncertainty starting to impact a lot of corporates. And we saw Delta, the first one to break cover yesterday, reducing their expectations now thanks to some of the economic uncertainty. How are you perceiving this market sell-off?
So I think that there is concerns about the tariffs for sure, but I think that feeds into a much larger picture where the concern really is about cracks in economic data here in the US, as well as the real risk of a stagflation environment, which is sort of a worst case scenario for the Fed. And so those things are giving people pause. Our employment numbers that came out last week had some concerning parts to it. And so all of those things are kind of leading to the market. So it's beyond tariffs, in my opinion. And I think it's warranted to feel this way. The tariffs will only accelerate a slowing economic conditions that existed prior to any of the new administration kind of coming into office.
Shana, the feature, though, this market, when we've seen concerns previously that there could be some slowdown coming, investors have hit out in technology names because a slower economy typically means lower borrowing costs. Those lower costs typically support technology, but we're not seeing that same level of support now. In fact, anything, these technology names are leading the sell-off. So how do you describe what we're seeing then in technology?
Well, that's exactly my point with stagflation, right? Because your point is that technology would do well because borrowing costs would go down, but that's not true in a stagflation environment. You can't lower rates in stagflation because you have potential for causing inflation to get out of control. So your tools to handle a slowing economic environment are kind of they don't work as well, and some of them you can't even use. And one of the policy things that you can't use is cutting rates in stagflation because of sticky inflation. So that's the real concern. That's why you're seeing, if you look at what sectors are doing really well, and then you look back at, say, the 1970s at what sectors tend to do well in that kind of environment, it's staples, it's healthcare, it's not technology, it's not discretionary. Those are the things that get hurt the most. And so for that reason, I think that's why you're seeing technology sell off. Plus the tariffs have a much greater impact on the technology sector than other sectors of the economy here in the US. And so that is also impacting technology stocks.
Shane, it feels like another way to describe what's been happening in markets is the end of the momentum trade. When you look at the stocks that have really performed poorly over the last couple of weeks. And I was looking at the Goldman Sachs Prime Broking report suggesting that hedge funds have been unwinding their positions aggressively. To what extent is this selling that we're seeing a result of hedge funds taking down their books?
I think a lot of the hedge funds were out of a lot of the tech names already. And while hedge funds certainly can take down their exposure, they tend not to have as much of an impact on the market unless it's related to their short book. And most of them weren't short the tech names. The largest asset managers here in the US that would have that kind of impact on the market aren't selling these stocks necessarily. I do think that maybe in the short term, some of that momentum related asset managers, hedge funds or otherwise, that use algorithms that track the 12-1 momentum indicators and price movement might be getting a signal that there's a turnover in the momentum factor. And that could certainly be affecting not just the hedge funds, but also any sort of quant related long only manager as well.
Is the Fed put still in place? The president has been basically brushing off concerns around the market sell-off. And I think part of the reason investors were optimistic until recently was that they didn't think that President Trump would be willing to endure that much pain. But it feels like he's cast a doubt now on that position.
Well, I think a guest you had on earlier said it best. This is his second term. He's not running for re-election here. He very clearly had ideas that he wanted to put in place as soon as he got into office. A lot of it was about cutting government waste. It was about tariffs. That was a huge part of his campaign. And he has done exactly what he said he's going to do. And he's not really worried about what that means for the markets or the like, because he can't run for another term. So he's less worried about how that will impact what happens next for him. He's more thinking about the longer term impact of how people will look back on him historically. And if the things he's doing now put America in a better place in the future, then he can kind of use that as his legacy. And I think he's looking at it from that perspective.
Shanna, let me come back to some of the big tech names, because no doubt the tech bros are screaming at the screen that this is a once-in-a-generational change that we're seeing with AI. Even though we've got market noise, we've got concerns around the economy, we still have this generational change in technology. Apple is one stock you've been looking at. It was leading the market south yesterday, the worst performer for the S&P 500 and also for the NASDAQ, dragging both of those indices south. What's your view on Apple? Because some said this stock was more protected because it hadn't gone deeply into AI like other companies.
But that's the problem. They had plans to roll out their AI solutions this year, and then they came out and said that it's unlikely to be rolled out in this fiscal year, and now it's looking more like 2026. That's actually the problem with Apple, is that they are so far behind, and they had these big plans that were supposed to encourage people to go out and buy the latest and greatest iPhone, and now they're saying that that's not happening. So that whole upgrade cycle thesis is falling apart. And also, when you think about AI and CapEx spending, there's been a lot of calls where executives have talked about the outlook for their CapEx as it relates to AI going forward. But if there's a softening of the economy and growth slows down, those CapEx spending decisions could change. Just because you say you're going to spend X amount of dollars doesn't mean you're going to spend them tomorrow. And if you have to hold off because the economy is slowing down, you will. And so that's kind of, the vicious cycle that starts to happen right now as we see a lot of concerning economic indicators and these tariff threats and the way that we're seeing retaliatory language as well from other countries suggests that this could be a bumpy ride for sure.
Shayna, thank you so much for joining us so early in the morning. Shayna Sissel, CEO of Banrian Capital Management. Monday was a day to forget for Elon Musk. Shares in Tesla suffered their biggest single-day decline since September 2020, tumbling 15%. The stock is on a 7-week losing run, with shares more than 50% off their December all-time high and more than $800 billion in market cap wiped out. Elsewhere, Musk's X platform suffered several outages throughout the day. He says the site had been the target of a cyber attack linked to IP addresses in the Ukraine area, but Reuters cited an industry source who said traffic from Ukraine was insignificant, and much of the activity appeared to be traced to the U.S., Vietnam, and Brazil, among others. Musk capped off the day with an interview on Fox Business in which he said he expects to remain a part of the Trump White House for another year, but also, and this is key, admitted he's struggling to keep up with running his companies.
Yeah, I mean, really, I just don't want America to go bankrupt.
So it's a call to action. You're hearing a call to action.
Yeah.
You giving up your other stuff? I mean, how are you running your other businesses?
With great difficulty. Yeah, I mean.
But there's no turning back, you're saying?
I'm just here trying to make government more efficient.
Can he stick around for another year is the big question. I mean, if you look at Tesla stock since Musk joined Doge, it's been losing territory every week. And at this point, the stock is down about 50, it's lost about 50% of its value since the 17th of December, 800 billion in market cap. To me, what we've got here is a Bitcoin problem. That's been part of its earnings profile recently, the revaluation accounting mark to market rather, that's helped the stock. You've got a buyer's strike on the stock market and you've got a customer backlash around Doge. So I wonder whether he can stick around.
Well, you've got a customer backlash against Doge, but also the simple practicality of him spending so much time in D.C. Running things at Doge. And I think, hearing him yesterday on Fox News admit that it has been very difficult to run both. And clearly Tesla is suffering to some extent because of that. We'll talk more about what drove Tesla shares down and whether investors should be stepping in here and what the analyst community is saying. But first, President Trump has weighed in saying that he promises he'll buy a brand new Tesla this morning in a show of support for Elon Musk. The president posted on Truth Social that Musk was doing a fantastic job and that, quote, radical left lunatics were seeking to punish him and what he stands for.
Coming up on the show, we'll discuss Europe's position in the global tech race. Our next guest says 2025 could prove to be a crucial year for the European tech ecosystem. Plus, President Trump is expected to meet C-suite executives today amid concerns over his tariff policy. We'll have more later this hour. And don't miss our interview with the Volkswagen CFO as the car maker prepares to release its full-year numbers today. That interview is coming up at 8:30 GMT. Punishing all day on the stock market yesterday. The Nasdaq down 4% and about 2 to 3% off the S&P 500 and the Dow. So this morning we're looking at a little bit of green creeping back on the board. Well, Europe is looking to gain ground in the global technology race, with countries including the US and China working to boost investment. Our next guest says Europe is ready to lead in the deep tech space. Thomas Oil, who's the co-founder and general partner of V Squared Ventures. Thomas, thank you so much for joining us. I think it's fair to say it's been a very positive environment for technology names and European stocks, and that has been really leading us to a very positive backdrop for Europe and growing the technology. Overnight and in recent sessions, though, stateside, we've seen punishing market action. Corporate bond sales yesterday were scrapped. Are you concerned that the funding environment could be changing on a dime as you look to grow deep tech in Europe?
Well, first of all, thanks for having me on the show. And obviously, it's a time of turmoil. And given the fact that we are working within the venture capital space, and capital is needed to thrive the European tech ecosystem in general, it's more about right now playing the ball like it is and saying, we have our strength, we have our core capacities that we can work on. So we're not particularly afraid, because Europe right now still is in that point where we need to unlock a lot more capital, which is existing. It's just not flowing in the directions where you can really foster technologies to thrive and be part of that race.
Thomas, I was looking at some of the funding numbers and can see that deep tech attracted 33% of European investment in 2024 versus 17% in 2015. So the money started to flow in the right direction. Where should the money be targeted? Because we've heard a lot of announcements out of the Chinese in recent weeks, from DeepSeek to Alibaba. What deep tech do we have in Europe that needs to be accelerated to catch up with the Chinese and, of course, the American counterparts?
Yeah, well, the thing is, I guess we are fairly covered well in terms of early stage investing across the board, not only in deep tech, but across venture. But it really is in the scale up phase where Europe is still lacking. It's very fragmented. There are not a lot of players and educated investors out there that can foster growth capital. And that's where we need to target our aims. And in particular, in terms of areas of interests where Europe is particularly strong, I would say it is quantum, it is space going forward, it is manufacturing, robotics, but also AI. But we need the bigger checks in the later rounds to really let the founders fulfill their vision and go big.
Is there an issue with the politicians in Europe in terms of creating an environment where companies can scale up to the extent that we've seen elsewhere, like in the US, like in China?
Yeah, well, regulation should foster innovation, not stifle it. So, setting up regulations that fit and use the existing ones to make them fit and drive these companies forward. This is really something where Europe has to act and work fast, because it is a disadvantage for now. And yeah, that's one of the main points where we try to educate all stakeholders to say, hey, we need to compete, and we need to have the right framework for that.
Well, looking at Germany specifically, clearly Germany has the capability of being a powerhouse economically. It's done this before. I mean, it was really the industrial powerhouse of Europe for so many years. But of late, now Germany has fallen behind, and a lot of the industries that propelled Germany to become this economic giant are no longer, relevant, or no longer current or innovative industries. But clearly innovation is possible in Germany. What needs to change to extract economic wealth out of the innovation that is taking place in Germany?
Yeah, well, I think the reason for the successes of the years been maintaining the status quo and run good companies. And there's a saying that good companies fail when they're well managed, because you just focus on your daily business, you focus what you're good at. And that's what been, I guess, the biggest problem. It been efficiency gains, making what you have a tad more efficient, instead of thinking what is beyond, what kind of technologies will drive the next industrial revolution. So by focusing on, if it's automotive, chemicals and whatsoever, everybody else been setting new cornerstones and seeding companies that just been something entirely new, entirely different, creating new industries. And this is where the industry players within Germany particularly need to step up. I mean, they need to take bold bets. They've done it before, they've done it in the past, but now it's the time to do it again, and not trying just to keep up with what you have, but seeing what's out there, and take on not only your own R&D, but make it external R&D if you want so. Invest in startup companies, invest in companies that create something entirely new. And then potentially buy them or acquire them or let them IPO, and see what comes out of these instead of the big ships that they have to drive.
Thomas, I want to talk about where we're heading in the future, because to me the tariff stateside, as we watch what Trump is trying to do in terms of shifting the narrative around the states, he's gearing up the supply chain around rare earths, around, you've got chips coming back into the mix, more manufacturing in the United States, and changing steel and aluminium, so there's more of that at home. To me, he is creating an autonomous United States for the future, where you're bringing back manufacturing, because the AI technology plus robotics is just going to simply lower the cost of manufacturing in developed countries. Do you see that as well? Do you see a paradigm shift where we're no longer talking about manufacturing in emerging markets? It's going to be just as cheap to manufacture in major countries right here in Europe as well?
Well, obviously that's a possibility. The thing is, if you look on the demographic shift, we need to have that technology in place to be capable to maintain the status quo and be productive. So I think it's twofold. There is a way where you can say you can make any kind of manufacturing so attractive that you can actually nearshore it or bring it back to your geography. And on the contrary, you need to substitute the workforces that will be missed in the future by these technologies to stay productive. And yes, obviously, you can start incentives, you can make tariffs, you can force people to and companies to produce just at home. But manufacturing still is, and making these robots and AI work, you need the right talent, you need the right people, the right environment to foster them. So, and I guess Europe is well set, so is the US.
Thomas, thank you so much for joining us today. Thomas Oil with us, the co-founder and general partner of V-Squared Ventures. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.